A man sits across from some of the world's most successful traders, armed with nothing but questions and an insatiable curiosity about what separates the winners from the losers in the markets. Over the course of decades, he would interview legends like Ray Dalio, Stanley Druckenmiller, and dozens of other trading titans who had turned modest sums into hundreds of millions. But here's what's fascinating. As Jack Schwager conducted these interviews, he began to notice something that would fundamentally change how we understand trading psychology. Something that every trader watching this needs to understand if they want to survive and thrive in the markets. The revelation? The very traits that make someone a successful trader often go against every natural human instinct we possess. The accidental discovery. Jack Schwager never set out to become the world's foremost authority on trading psychology. In fact, his journey began almost by accident. As a trader and fund manager himself, he understood the brutal reality of the markets, that most people who enter trading lose money, often spectacularly. But Schwager had a unique advantage that most traders don't: access. Through his work in the industry, he could sit down with traders who had achieved what most only dream of. Not the self-proclaimed gurus selling courses, but actual verified performers who had generated real returns over real time periods. As I've learned in my own trading career, there's a world of difference between someone who talks about trading and someone who actually trades. Schwager understood this distinction better than anyone, which is why his verification process became legendary in the industry. The verification wasn't just about P and L statements, though those were essential. Sometimes it meant spending days in a trader's office, observing their process, understanding their methodology. In some cases, like with Jimmy Bolotimus, a prop trader at First New York, traditional verification was impossible because the firm wouldn't release records. But Schwager's own son worked as Bolotimus's assistant, providing first-hand confirmation of his extraordinary success. This attention to authenticity would become the foundation of everything Schwager built. In a world full of trading mythology and get-rich-quick schemes, he was documenting the real thing. The pattern emerges. As Schwager conducted interview after interview, a startling pattern began to emerge. These successful traders weren't just different from losing traders, they were different from each other in almost every conceivable way. Michael Marcus turned $30,000 into over $80 million using one approach. Bruce Kovner, whom Marcus hired, developed a completely different methodology and became one of the most famous traders of the past 4 decades. Stanley Druckenmiller made billions with his own unique style. Each had found their own path to success. This discovery challenged everything the trading education industry was teaching. While most trading courses promised cookie-cutter approaches, follow these rules and you'll be profitable, Schwager was documenting something far more complex and infinitely more interesting. The successful traders had found approaches that matched their personalities, their risk tolerance, their psychological makeup. Marcus famously told Schwager, "You have to follow your own light. If you try to combine 2 traders, you'll get the worst of both." This wasn't just advice, it was a fundamental truth about human nature and market success. But here's where it gets really interesting for us as traders. While their methods differed dramatically, their psychological traits showed remarkable consistency. The universal traits. Through hundreds of hours of interviews, Schwager identified the psychological DNA that successful traders shared, regardless of their strategy or time frame. Risk management as religion. The first trait was almost universal, an obsession with risk management. Not as an afterthought, not as something they got around to eventually, but as the cornerstone of their entire approach. This wasn't just about stop losses, though many used them religiously. It was about a fundamental understanding that preservation of capital comes before everything else. As one trader after another told Schwager, "You can't make money if you're not in the game." In my own experience, I've seen this principle violated countless times by developing traders. They focus on entry signals, on profit targets, on being right, but they treat risk management as a secondary concern. The professionals Schwager interviewed had it completely backwards from the amateur mindset. They assumed they would be wrong, planned for losses, and structured every trade around what could go wrong, rather than what could go right. the independent streak. The second trait was fierce independence. These traders didn't follow the crowd, didn't base decisions on what others were doing, and certainly didn't let emotions or opinions sway their judgment. This independence showed up in fascinating ways. Some traders had very structured routines and rigid discipline. Others were more fluid and adaptive. But all of them had developed their own way of seeing and interpreting market information. Schwager discovered that this independence wasn't just about trading methodology. It was about psychological resilience. The markets have a way of punishing herd behavior, and successful traders had learned to trust their own analysis even when it contradicted popular opinion. Learning from losses. Perhaps the most crucial trait Schwager identified was how these traders dealt with losses. While amateur traders treated losses as failures, professionals treated them as data. The best traders Schwager interviewed kept detailed records, not just of their wins, but especially of their mistakes. Some showed him binders filled with trade-by-trade analysis, examining what went wrong and why. This wasn't masochism. It was systematic improvement. But here's the key distinction Schwager emphasized. These traders distinguished between losses and mistakes. A loss could happen even when everything was done correctly, and that's just probability. A mistake was when they violated their own rules or let emotions override their process. This psychological reframe is crucial for developing traders. I've seen too many traders abandon profitable strategies after a few losses, not understanding that losses are part of the expected outcome, not evidence of system failure. The dangerous advice problem. As Schwager's work gained recognition, he began to notice a disturbing trend in how his interviews were being interpreted. Traders would read about Stanley Druckenmiller's massive position sizing on high-conviction trades and try to replicate it. They'd read about Jimmy Balademus fighting the market and breaking every conventional rule and think they could do the same. This led to what Schwager called the dangerous advice problem. Techniques that worked for experienced professionals with years of market experience and refined risk management skills were being copied by beginners who lacked the context to use them safely. Druckenmiller could bet billions on a single trade because he had developed the skill to recognize when the odds were heavily in his favor. And more importantly, he had the psychological fortitude to cut losses quickly when he was wrong. A beginning trader attempting the same approach would likely blow up their account on the first mistake. This insight revolutionized how Schwager thought about trading education. It wasn't enough to document what successful traders did. You had to understand the evolution of their approach and the experience that allowed them to break conventional rules safely. The verification revolution. Schwager's emphasis on verification became increasingly important as the trading education industry exploded. Anyone could claim to be a successful trader, post fake screenshots, or cherry-pick their best trades. But Schwager's standard was uncompromising. Show me the brokerage statements. This wasn't always easy. Prop traders often couldn't provide statements because firms wouldn't release them. In those cases, Schwager relied on other forms of verification industry reputation, recommendations from other verified traders, or in the case of Balademus, first-hand knowledge from his own son. The verification process revealed something troubling. Many people selling trading education couldn't meet basic standards of proof. They had theories, they had backtests, they had stories, but they couldn't demonstrate consistent profitability over meaningful time periods. This created a paradox that exists to this day. The traders with the most valuable insights were often the least likely to sell courses or seek publicity. They were too busy managing money and didn't need the additional income. Meanwhile, those most eager to teach often had the least to offer. The technology revolution. As Schwager's career progressed, he witnessed a fundamental transformation in trading. When he started, retail traders faced enormous barriers: high commissions, limited access to information, expensive data feeds. Professional traders had overwhelming advantages in terms of technology and information access. But technology democratized many aspects of trading. Commissions dropped to near zero. Real-time data became freely available. Sophisticated analysis tools that once cost thousands of dollars became accessible to anyone with a smartphone. This created new opportunities, but also new challenges. While the barriers to entry dropped dramatically, the level of competition increased exponentially. Retail traders were no longer just competing with other retail traders, but with firms employing hundreds of PhDs and using artificial intelligence. Schwager observed that this technological revolution had a double-edged effect on trading psychology. On one hand, it enabled new approaches and strategies. Traders like Chris Kacher could use social media sentiment analysis, something that didn't exist when Schwager wrote his first book. On the other hand, the ease of access led to a flood of unprepared participants. The low commissions that benefited serious traders also enabled gambling behavior from people who should never have risked significant capital in the markets. The human nature problem. Perhaps Schwager's most profound insight was about human nature itself. Through decades of observing both successful and unsuccessful traders, he came to understand that most people are psychologically unsuited for trading success. This wasn't a moral judgment. It was an observation about evolutionary psychology. The traits that helped humans survive in ancient environments often work against us in markets. Our instinct to cut gains short and let losses run, our tendency to follow the crowd, our desire for certainty in an uncertain world. These natural tendencies create systematic disadvantages in trading. Bill Eckhart, one of the traders Schwager interviewed, put it starkly. People are so poorly adapted to trading that they will perform worse than random chance. Not just lose money to transaction costs, but actually make decisions that have negative expected value. This insight helped explain why trading success is so rare and why it can't be easily taught through simple rule following. Successful trading requires not just learning new skills, but actively working against deeply ingrained psychological tendencies. The mentorship paradox. One of Schwager's most interesting discoveries was the paradoxical role of mentorship in trading success. Many of the successful traders he interviewed had learned from mentors or worked in environments where they could observe successful approaches. But ultimately, they all developed their own unique styles. This created what Schwager called the mentorship paradox. Learning from others was often crucial for getting started, but long-term success required breaking away from the mentor's approach and finding your own path. Marcus hired Kovner and they worked in the same office, yet their approaches were completely different. Both were enormously successful, but neither could have succeeded using the other's methodology. This has profound implications for trading education. While studying successful traders can provide inspiration and general principles, trying to copy their exact approach often leads to failure. The psychology that works for one person may be completely wrong for another. The modern challenge. As trading technology continued to evolve, Schwager recognized new challenges emerging. The rise of social media created new forms of market influence and new psychological pressures. Traders could now watch others' successes and failures in real time, creating comparison anxiety and FOMO that didn't exist in earlier eras. The gamification of trading through apps and social media made it easier than ever for people to start trading, but also easier to develop harmful habits. The instant gratification of modern technology conflicted with the patience and discipline required for trading success. Schwager also observed the impact of cryptocurrency and meme stock phenomena. These created new narratives about easy wealth that attracted people who might otherwise never have considered trading. The stories of ordinary people making millions on Dogecoin or GameStop created the same psychological traps that had existed for decades, but amplified through social media. The verification solution. Recognizing these modern challenges, Schwager co-founded FundSeeder, a platform designed to connect genuine trading talent with capital. The concept was elegantly simple. Create a verification system that couldn't be gamed, then use that to identify traders worth backing. Unlike traditional approaches that relied on self-reported returns, FundSeeder required traders to link their actual brokerage accounts. This eliminated the possibility of fake results or cherry-picked performance. The platform provided detailed analytics automatically, removing the burden of manual record-keeping while ensuring accuracy. The platform addressed two problems simultaneously. Talented traders around the world often lacked access to significant capital, regardless of their skill level. Geographic location, educational background, or networking connections could prevent genuinely skilled traders from advancing their careers. Meanwhile, investors were pouring money into large hedge funds that often delivered mediocre returns, while potentially superior smaller traders couldn't access institutional capital. Fund Seeder created a meritocracy based purely on verified performance. A talented trader in Eastern Europe with excellent risk-adjusted returns could compete on equal footing with someone from a prestigious background, but inferior results. The psychology of scale. Through his work with Fund Seeder and continued market observation, Schwager gained new insights into trading psychology at different scales. He noticed that many traders' best years came early in their careers, before they were managing enormous sums. This wasn't just about market impact, though that was certainly a factor. It was about psychology. Managing 10 million required different mental skills than managing 10 billion. The psychological pressure of managing other people's money often changed how traders approached markets. Some traders thrived under this pressure, using the accountability to improve their discipline. Others found that external expectations interfered with their natural trading instincts. This insight had important implications for developing traders. The psychological skills required for managing a small personal account might be quite different from those needed for institutional trading. Success at one level didn't guarantee success at another. The learning curve reality. Based on his extensive interactions with successful traders, Schwager developed strong opinions about learning timelines. He believed that developing genuine trading skill typically took 3 to 5 years of focused effort. This estimate was based on observing the career trajectories of successful traders. Most went through extended periods of struggle, learning, and adaptation before finding approaches that worked consistently. But Schwager also recognized that time alone wasn't sufficient. Some traders could spend decades in the markets without developing profitable skills. The difference wasn't just persistence, it was the quality of learning. The successful traders had learned to treat losses as learning opportunities rather than failures. They kept detailed records and analyzed their mistakes systematically. They remained curious and adaptive rather than defensive about their approach. Most importantly, they recognized when they were fighting against their own psychology and found ways to work with their natural tendencies rather than against them. The timeless principles. Despite all the technological and market changes Schwager witnessed, certain psychological principles remained constant. Human nature didn't evolve, so the fundamental challenges of trading psychology stayed the same. Fear and greed still drove most market participants. The tendency to cut winners short and let losers run persisted across all time periods and market types. The desire for certainty in an uncertain world continued to create psychological stress for traders. These timeless principles meant that, while trading strategies might evolve, the psychological work remained similar. Successful traders still needed to develop emotional discipline, independent thinking, and systematic approaches to learning from mistakes. The legacy question. As Schwager reflected on his career and the impact of his work, he grappled with a complex question: had he helped or hurt the trading community? On one hand, his books had inspired countless traders to pursue careers they might never have considered. Many had gone on to tremendous success, building wealth and contributing to market efficiency. On the other hand, his work had also attracted people to trading who might have been better served by other careers. The glamorization of trading success, even when presented responsibly, could encourage gambling behavior in vulnerable individuals. Schwager came to view this as part of a larger truth about markets. They were powerful wealth creation tools for those with the right skills and psychology, but dangerous for those without proper preparation. His solution was to continue emphasizing the difficulty and complexity of trading success while providing resources for those serious about developing genuine skills. The next generation. Looking toward the future, Schwager recognized that each new generation of traders would face unique challenges while dealing with the same underlying psychological realities. Artificial intelligence and algorithmic trading were changing market dynamics. But human psychology remained constant. New technologies created new opportunities for both genuine skill development and dangerous speculation. The key for developing traders was to focus on timeless principles while adapting to changing market conditions. Risk management, independent thinking, and systematic learning remained as important as ever. But these principles needed to be applied within the context of modern markets, with their faster pace, increased complexity, and global interconnectedness. The personal cost. Throughout his career, Schwager observed the personal toll that trading could take, even on successful practitioners. The stress of managing risk, the isolation of independent decision-making, and the emotional demands of dealing with constant uncertainty affected even the most skilled traders. Some thrived on this challenge, treating trading as an intellectual game that never lost its appeal. Others achieved financial success, but eventually burned out from the psychological demands. This led to another important insight. Trading success wasn't just about making money, but about finding approaches that were psychologically sustainable over long periods. The most successful traders found ways to manage stress, maintain perspective, and preserve their mental health while competing in demanding markets. The verification evolution. As his career progressed, Schwager's approach to verification became more sophisticated. He realized that track record verification was just the beginning. Understanding the sustainability and repeatability of a trader's approach was equally important. Some traders had excellent short-term records that weren't sustainable. Others had modest returns but exceptional consistency and risk management. The challenge was identifying which traits predicted long-term success. This led to deeper psychological profiling in his interviews. Understanding not just what traders did, but why they did it and how they thought about markets became crucial for predicting future success. The education dilemma. Schwager's work highlighted a fundamental dilemma in trading education. The most valuable insights often couldn't be taught directly. They had to be discovered through experience. Telling someone that losses are learning opportunities is very different from actually learning that lesson through painful experience. Explaining the importance of risk management doesn't create the emotional discipline needed to cut losses when it matters. This suggested that the best trading education focused on accelerating the learning process, rather than trying to shortcut it entirely. Providing frameworks for thinking about markets, tools for analyzing performance, and examples of successful approaches, but ultimately leaving each trader to find their own path. The global perspective. Through Fundseeder and his continued market observation, Schwager gained a truly global perspective on trading talent. He discovered that geographical location had little correlation with trading ability. Skilled traders existed everywhere, but opportunities were unevenly distributed. This global view reinforced his belief in meritocracy. When traders were judged purely on verified performance, rather than credentials or connections, talent emerged from unexpected places. It also highlighted the importance of technology in democratizing opportunity. Platforms that could verify performance and connect talent with capital could level playing fields that had been tilted by geography and privilege. The emotional revelation. Perhaps Schwager's most profound discovery was about the emotional relationship successful traders had with their work. The best traders had learned to treat trading as a game rather than a source of emotional validation. This didn't mean they were cavalier about losses, quite the opposite. But they had separated their self-worth from their trading results in a way that allowed them to make rational decisions even under pressure. Paul Tudor Jones shared a story about Eli Tullis, a cotton trader who had suffered enormous losses, but remained jovial with visitors, never letting his bad day show. This emotional regulation wasn't just impressive, it was essential for long-term success. The conclusion that changes everything. After decades of interviews, research, and market observation, Schwager arrived at a conclusion that challenges everything most people believe about trading success. The traits that make someone a successful trader aren't just rare, they're often contrary to normal human psychology. This means that for most people, the best trading strategy is to act as if markets were perfectly efficient, buy index funds, and forget about active trading. But for the small percentage of people who have the psychological makeup for trading success, the rewards can be extraordinary. The key is honest self-assessment. Do you have the rare combination of traits that successful trading requires? This isn't about intelligence or education. Some of history's most successful traders lacked formal credentials. It's about psychological traits, the ability to accept uncertainty, learn from losses, think independently, and manage risks systematically. If you possess these traits, Schwager's work provides a roadmap for development. Study the examples of successful traders, but ultimately find your own approach. Focus on risk management above all else. Learn systematically from your mistakes, and never stop adapting to changing market conditions. If you lack these traits, there's no shame in choosing a different path. Markets don't care about your ego or your need to be right. They reward those who understand themselves and their limitations. The greatest insight from Jack Schwager's decades of work isn't about trading techniques or market analysis. It's about the brutal honesty required to assess whether you belong in this game at all. And if you do belong here, the journey of developing genuine trading skill while challenging offers rewards that extend far beyond financial returns. It's a path of continuous learning, psychological growth, and the deep satisfaction that comes from mastering one of the most intellectually demanding games in the world. The market wizards Schwager interviewed weren't born with supernatural abilities. They were ordinary people who developed extraordinary skills through dedication, discipline, and an unflinching commitment to truth, both about markets and about themselves. That opportunity exists for every serious trader. But as Schwager's work makes clear, few will have the psychological fortitude to seize it. The question isn't whether you can learn to trade. The question is whether you have what it takes to learn about yourself,